It's 2 a.m. again and the charts are quiet. No alerts, no flashing candles, just the soft hum of the monitors and the silence between thoughts. In this space between one trade and the next, something deeper begins to speak. Not a signal from the market, but a signal from within. This is the hour when the emotional noise fades. When there's no FOMO, no panic, no greed, just you and the weight of what you believe about the market and about yourself. If this kind of quiet, thoughtful trading content speaks to you, consider subscribing. It helps keep this space alive. Put on your headphones. Dim the lights. Let's begin. The stillness before the bell. There's a kind of ceremony to trading that only a few ever notice. Not the entries or exits, not the screens, but the moment before. Before you click, before you act. There's a breath, a hesitation, and inside that pause lives the truth of your mindset. Mark Douglas called it being in the zone, a mental state where the trader becomes effortless, focused, emotionally neutral, where every move flows not from force, but from presence. But how do you get there? Let me explain. Most traders begin their journey thinking the edge is technical, the right strategy, the perfect indicator, the secret setup. But over time, if they last long enough, they discover something else. That two people can trade the exact same system, one will thrive, the other will bleed out slowly. Same market, same rules, different results. Why? Because the game is internal. What you bring to the chart, your beliefs, your fears, your habits shapes what you see. And what you see shapes what you do. Every trade becomes a mirror. Douglas taught us that the market doesn't owe us anything. It's not there to reward our intelligence or punish our mistakes. It just is. That's a hard truth, because we're conditioned to believe in cause and effect. Work hard, get results. Be smart, be rewarded. But the market doesn't care. You can do everything right. Proper analysis, perfect timing, and still take a loss. Not because you were wrong, but because randomness exists. And that's where most traders unravel. They mistake outcomes for truth. They measure their skill by the last candle. They chase certainty. And certainty doesn't live here. The market is a place of probabilities, not guarantees. And that's the shift. That's the mental divide between the amateur and the professional. Between the trader who burns out and the one who begins to see. See what? That mastery isn't about control, it's about acceptance. Acceptance of loss, acceptance of randomness, acceptance of self. The stillness before the bell, before the trade, that's your gateway. That's where your mindset is revealed. Not built in that moment, just revealed. So, the question isn't how do I control the market? It's how do I meet the market as I am and not flinch? There's a quote from Paul Tudor Jones. He said, "The secret to being successful from a trading perspective is to have an indefatigable and undying and unquenchable thirst for information and knowledge. But that knowledge isn't always on the charts, it's inside. It's learning the patterns of your reactions, your tilt triggers, your impatience, your hidden need to win. Because when those are unknown, they leak into your decisions. And slowly, trade by trade, they cost you. Not just money, but clarity. That's why this quiet hour matters. Not to plan trades, but to study the one making them. The first market to master is your own mind. And like any market, it has trends, ranges, volatility, drawdowns. There are days when you're clear, sharp, emotionally flatlined in the best way. And there are days when you're scattered, grasping for setups, trying to make something happen. If you can notice the difference, if you can see it before you act, you're already ahead of most. That's what Douglas meant when he said, "The consistency you seek is in your mind, not the markets." Read that again. The consistency you seek is in your mind, not the markets. It's not about calling tops or bottoms. It's not about being right more than you're wrong. It's about executing your edge without hesitation over time, without needing the next trade to define you. And if that word edge feels unfamiliar, leave a comment. I or someone from the community will help explain it. This is a place for thoughtful learners. In time, you'll realize this strange paradox. The more you need the market to give you something, the less it will. But the more you trust your process, your edge, your risk management, your detachment, the more the market slowly opens. Not in reward, but in rhythm. You stop trading outcomes. You start trading process. And somewhere in that shift, something quiet happens. You stop chasing the money and start becoming the kind of person who deserves it. That's the real transformation, not in strategy but in self. So if you're here tonight staring at charts that won't speak, good, stay there. Not every trade is worth taking, but every silence is worth listening to. That's the stillness before the bell. And it's where mastery begins. There's a strange comfort in pretending the market makes sense. That if we study hard enough, wait long enough, we'll crack some hidden code. Like there's a secret level in the game where every candle tells the truth. But the deeper I go into this craft, the more I realize that belief is dangerous. Because it's not the market we're trying to control. It's ourselves. Control is a fantasy, a comforting lie. And in trading, it's the most seductive one we tell. We want to believe that our system is airtight, that our edge is enough, that if we just backtest harder, watch more YouTube, tweak our stop loss by 1 decimal, we'll win. And sometimes we do. Sometimes the trade goes our way and it feels like control. But that's not control. That's coincidence. Let me put it like this. The best traders in the world lose. Regularly. They lose not because they're careless, but because they understand something most traders never accept. Markets are probabilistic. They don't reward the right decision every time. They reward the disciplined decision played out across hundreds, even thousands of trades. Ray Dalio said it simply, "You can be wrong and still make money. You can be right and still lose money." The outcome of one trade means almost nothing. But our brains aren't built to believe that. Our wiring is ancient. We're pattern seekers. We confuse correlation with causation. And worst of all, we personalize everything. A loss becomes a verdict. A win becomes validation. And so we start adjusting things that don't need fixing. We deviate. We double down. We trade not from logic, but from noise. It's not that your system failed. It's that your ego couldn't let go. Douglas warned us, anything can happen. You don't need to know what's going to happen next in order to make money. That sentence rewired something for me, because I'd been approaching trading like a puzzle. If I just knew enough, I could outsmart the chaos. But trading isn't a puzzle. It's more like poker. You make your best move based on the odds, not because you know what's coming, but because you've accepted what you don't. It's hard to sit in that uncertainty, to place a trade knowing you could lose and still feel calm. But that's where the zone lives. And here's the paradox. The less you try to control the outcome, the more control you gain over your reactions. Let me tell you a story. There was a stretch, months maybe, when I couldn't take a loss without spiraling. Every red trade made me question my system, my skill, even my identity. I'd wake up dreading the open, overtrade, over-leverage, convince myself that the next win would fix it. It never did, because I wasn't trading the chart. I was trading my emotions. And the market, indifferent as it is, kept showing me the same lesson. You're not in control. Eventually, I stopped fighting it. I stopped trying to predict. Started playing the edge. Not perfectly, not coldly, but calmly. I'd ask myself, before a trade, if this loses, will I still feel clear? If the answer was no, I wouldn't take it. Because that meant I was too attached to the outcome, too dependent, too fragile. And trading from that place, it's a form of emotional gambling. Here's what I learned in that season. The real edge is not the strategy. It's the emotional posture from which you execute it. Because when your mindset is reactive, you distort the data. You see what you want to see, you chase, you hesitate, you revenge trade, and slowly you burn. But when you surrender control not in weakness, but in wisdom, the pressure lifts. The need to be right dissolves. And what's left is space. Space to think clearly, space to act with purpose, space to let the probabilities play out. That's what the pros mean when they talk about process. Jesse Livermore, who knew both fortune and ruin, once said, "A man must believe in himself and his judgment if he expects to make a living at this game." That is why I don't believe in tips. Tips are another form of trying to outsource control. But every trade is a reflection of your own internal state. No one can trade that for you. So if you find yourself clenching around the charts, forcing entries, watching the P and L more than the price action, pause. You're not trading the market. You're trading your need to control it. And that need unchecked will drain you, not just financially, but mentally, emotionally, spiritually even. Because trading done poorly becomes a war against reality. But trading done well becomes an agreement with it. You stop resisting. You start aligning. You embrace what Douglas called thinking in probabilities. And with that shift, the illusion fades. Control isn't power, acceptance is. So tonight, or whenever you're listening, if you're holding a trade or thinking about the next one, check your grip. Are you trying to make the market obey? Or are you ready to let go? Trust your edge and let the numbers do what they do. Because in the end, the market doesn't bend to your will, but it does reward those who stop needing it to. There's a moment that happens right before you click buy or sell. A flicker in the gut. Not fear exactly, but something close. It's the awareness of risk. And most of us flinch. We try to suppress it, or rationalize it, or ignore it altogether. But that feeling, that pulse of uncertainty, it's not the problem. It's the invitation. See, we've been taught to think of risk as something to avoid, as danger, as threat. But in the markets, risk is the cost of admission. It's not optional. Warren Buffett once said, "Risk comes from not knowing what you're doing." And he's right to a point. But even when you do know, risk remains, because markets are fluid, unpredictable, prone to the irrational. Risk isn't the enemy. Misunderstanding it is. Let me explain. In trading, risk is measurable. You can define it. You can limit it. But you can't erase it. That's where tools like position sizing and risk-reward ratios come in. If those terms feel unfamiliar, don't worry. Leave a comment, and someone here will break it down with you. At its core, position sizing is about how much of your capital you allocate to a trade. Not randomly, not emotionally, but based on math, based on your tolerance, and your risk-reward ratio. It's the relationship between what you're willing to lose and what you stand to gain. Simple example. If you risk $100 to potentially make $300, you're trading a 1-to-3 risk-reward ratio. That ratio, over time, becomes your shield. Because it means you don't have to be right every time to win. Let's say your win rate is just 40%. If you stick to a 1-to-3 ratio, you still come out ahead. It's not about being right, it's about being structured. That's the shift. You stop thinking like a gambler. Start thinking like a risk manager. And once you do, something beautiful happens. Fear starts to loosen its grip. Not because the risk is gone, it's still there, but because it's defined. And defined risk is manageable. Douglas called this accepting the risk. Not just intellectually, but emotionally, deeply. He wrote, "When you truly accept the risk, you will be at peace with any outcome. If you are not at peace, it means you haven't truly accepted it." Read that again. That's the litmus test. If a single trade can still rattle you, if a red candle ruins your day, you haven't accepted the risk. And that means your mindset isn't stable. Because here's what's often misunderstood: risk isn't just in the market. It's in you, your beliefs, your emotional reactivity, your unwillingness to lose. And unless you've dealt with those, you'll always overexpose yourself, not just in capital, but in ego. Every trade becomes a test of your worth, every loss a wound. And slowly, trading becomes something toxic. Not growth, but self-punishment. But it doesn't have to be that way. There's another path. It starts by seeing risk as a partner, not an enemy. Risk is the price you pay for the possibility of gain. It's the cost of opportunity. And if you treat it with respect, if you structure your trades, protect your downside, and stay emotionally neutral, Risk becomes manageable, predictable even, and over time you build something most traders never find: resilience. You stop needing every trade to work. You start seeing losses not as failures, but as part of the equation. There's a trader I knew very methodical. He never risked more than 1% per trade. He journaled every decision. And what struck me most wasn't his system. It was how unshaken he was by loss. He once told me, "I've lost money on trades, but I've never lost sleep. That's how I know my risk is in the right place." That stuck with me, because most of us lose sleep over trades, not because of the dollar amount, but because we weren't honest about the risk. We were secretly hoping it wouldn't happen, and when it did, it hurt. But a professional doesn't hope. A professional prepares. They size small. They plan exits. They respect volatility. Volatility, that's another one. We think of it as chaos, but volatility is just movement. It's the rhythm of the market breathing in and out. You can fear it, or you can flow with it, but you can't control it. What you can control is how you engage with it, how much you risk, where you place your stops, how you frame your expectations. This is why Douglas emphasized mental stop-outs as much as technical ones, because it's not just about the chart. It's about knowing when you are no longer in the right headspace to trade. That's risk management too, guarding your mind as much as your capital. So if you're here thinking about your next trade, ask yourself, what am I really risking? Money, ego, sanity. Am I okay with the loss, if it comes? Truly okay. If not, pause, breathe, adjust. Because the traders who survive long enough to thrive are the ones who respect risk as sacred. They don't run from it, they dance with it. And slowly, over time, that dance becomes graceful, effortless, almost quiet. That's where we're headed. It's strange how something as impersonal as a chart can become a mirror for everything we feel. Hope, fear, greed, regret. All laid out in red and green. You'd think trading would be purely logical, clean, rational. A game of numbers, not nerves. But the truth is, most of what we do, most of the choices that shape our account aren't made by the system we trade. They're made by the state we're in when we trade it. Let me explain. Every candle on the chart reflects not just price action, but mass psychology. It's a fingerprint of emotion. Price goes up, people get excited, they buy late, they chase, then it reverses and they panic. Sell at the low. Repeat. It's not a system failure, it's an emotional cycle. And the deeper truth, you're not separate from it. The crowd you think you're outsmarting, you're part of it, unless you become conscious. Mark Douglas understood this better than almost anyone. He wrote, "The best traders think in probabilities and have learned to accept risk. They have no expectations. They trust their edge." Let's pause there. No expectations. That line is heavy, because most of us come into trades hoping. We hope it goes our way. Hope it hits our target. Hope it fills the void we're carrying. The loss we want to erase. The win we want to prove. But hope is not a strategy. It's just unspoken fear dressed up. And fear is the most expensive emotion in trading. Not because it's loud, but because it whispers. It tells you to cut your winners early, to hold on to losers longer than you should. It says, what if this is the one? What if you're wrong again? What if you miss it? And so we react, not to the market, but to our own story about the market. There was a trader I coached once, disciplined, smart, well-read. But every time he took a loss, he spiraled. Not because he didn't understand the numbers, but because deep down, each trade was tied to his sense of worth. His identity was on the line. And when that happens, it's not a trade anymore. It's a test, a referendum. And those are trades you lose, even when you win. Because the market doesn't care how you feel. but it will reflect what you feel if you're not careful. Here's what I mean. You're anxious, so you trade too soon. You're angry, so you double your size. You're desperate, so you ignore your plan. You're euphoric, so you break your rules. And each time the chart looks the same, but the outcome changes. Not because of the setup, but because of the state you were in when you clicked. That's why mindset matters more than method. Because even the best strategy won't save you from yourself. So how do we start to separate? How do we stop trading from emotion and start trading from clarity? The answer begins with awareness. Before every session, ask yourself, what am I carrying today? Am I calm? Am I clear? Am I still haunted by that last loss? Still hungry to make it back? Be honest. No one's watching. But your account will feel the truth. If you're off, take the day. If your hands are shaking, step away. Because trading is not about proving something, it's about protecting something. Your peace, your process, your capital. Douglas talked about this as emotional objectivity, being able to see the market without seeing your fears in it. It's a skill, a muscle, and it's built in silence, through journaling, through meditation, through time spent not trading but thinking. I keep a small notebook, nothing fancy, but in it I write how I feel before I trade. 3 lines max. And over time I started to see the pattern. When I felt rushed, I lost. When I felt calm, I followed my plan. When I felt revenge, I made mistakes. Simple, right, but powerful. Because once you name the emotion, it loses some of its power. You see it instead of being it. That's the key. Jesse Livermore once said, "The market does not beat them. They beat themselves because though they have brains, they cannot sit tight." Sitting tight not just in the trade, but in your mind, still, unreactive, present. That's the zone. It's not magic. It's not luck. It's emotional discipline built moment by moment. And it's fragile. You can lose it with one impulse, one trade too many, one belief you didn't question. So protect it, not with force, but with softness, with routine, with rest, with space. Because the market is loud, but your best trades come from quiet, not from the noise of should I or shouldn't I, but from the stillness of I know my edge and I trust it. So tonight or tomorrow, before you click anything, breathe. Ask, is this trade coming from clarity or from emotion? And let the answer guide you. It's a quiet truth most traders resist. You don't know what's going to happen next. You can study every candle, run every back test, watch every interview, and read every book. But still you don't know. And that's not a weakness, it's a condition. The markets are uncertain by nature. What we do as traders is not prediction. It's decision-making under uncertainty. Let me say that again, slowly. Trading is not predicting. It is managing uncertainty with structure. Mark Douglas called this thinking in probabilities. And once you really understand that, everything shifts, because it means you're no longer trying to be right. You're trying to be aligned. Aligned with your edge. Aligned with your rules. Aligned with the reality that no single outcome matters. You start to see the game for what it is. A distribution of outcomes across many trades. Not one bet, but a series of structured risks. That's why professional traders don't focus on the result of one trade. They focus on execution. Did I follow my rules? Did I size correctly? Did I manage my emotions? Because when you think in probabilities, you detach from the outcome. Not because you don't care, but because you've accepted the randomness. Let's talk about that randomness. Imagine flipping a coin. You know there's a 50-50 chance of heads or tails, but flip it 10 times and you might get heads 7 times. Does that mean the coin is broken? No, it's variance. The same applies to trading. You might have an edge that wins 60% of the time, but in a small sample, 5 trades, 10 trades, anything can happen. That's not failure. That's randomness playing out. Understanding this changes everything. You stop overreacting to losses. You stop chasing wins. You stop thinking the market is out to get you. Because it's not. It's just doing what it does. Moving in probabilities, not certainties. Ray Dalio once said, "He who lives by the crystal ball will eat shattered glass." And it's true. The more you try to predict, the more pain you invite. But if you build a system, test it, refine it, execute it with discipline, then each trade becomes just another roll of the dice. You don't need to know what happens next. You just need to know that over time, your process works. It's like a casino. Think about it. The house doesn't know which player will win on which hand, but it knows that over hundreds, thousands of hands, the edge kicks in, and the house wins. You are the house. If you manage your risk, if you follow your plan, if you let your edge play out over time. But most traders don't want that. They want certainty. They want control. So they overanalyze, overtrade, overthink, and they burn out. Let me tell you something that might feel uncomfortable. You can do everything right and still lose, and you can do everything wrong and still win. That's the nature of probabilities. Short-term randomness, long-term truth, but only if you stay in the game long enough for the math to matter. That's why drawdown is such an important concept. It's the inevitable dip between where you are and where your edge eventually pays off. And if you don't manage your expectations, if you think your system has to work right away, you'll abandon it in the storm. You'll break your rules, and that's when the real damage begins. Drawdowns are not a sign you're failing. They're the cost of playing a probabilistic game. Benjamin Graham wrote The Investor's Chief Problem, and even his worst enemy is likely to be himself. That's especially true in a drawdown, because it's there that all the old stories rise up. The self-doubt, the fear of missing out, the pressure to make it back. But if you stay grounded in probabilities, you can breathe through it. You can say, "I've tested this edge. I know my numbers. This is just variance." And you keep going, not blindly, but with calm conviction. This is why process is more important than outcome. A good process repeated over time leads to favorable outcomes. Not every time, but over time. And if your process includes clear entry criteria, proper risk management, emotional discipline, then your only job is to show up and execute. Let go of the need to predict. Replace it with the will to perform. That's trading in the zone. You're no longer fighting the market or yourself. You're just flowing, detached, present, engaged, one trade at a time. So the next time you stare at a chart, ask yourself, am I trying to predict or am I trusting my process? Because only one of those leads to peace. There's a strange comfort in believing we're in control, that if we just study hard enough, plan long enough, tweak the system just right, we'll eliminate uncertainty, we'll master the market, we'll know what's coming, we'll win every time. But here's the hard truth. The market doesn't care. It doesn't care about your feelings. It doesn't care about your confidence. It doesn't care how perfect your analysis is. Control is an illusion. And in trading, clinging to that illusion is a fast way to suffer. Let me explain. Every trade you take, no matter how confident you feel, exists in a system bigger than you. Macroeconomic data, central bank policy, geopolitical events, sudden volume shifts. You can't control any of it. All you control is how you respond. But that's where most traders get stuck. They believe that if they just work harder, they'll gain more control. And so they tighten their grip. They over-optimize strategies. They stare at screens for hours. They jump between systems seeking perfection. They think, if I can just eliminate the losses, I'll finally be free. But that's not freedom. That's fear disguised as discipline. Real discipline isn't about control, it's about surrender. Surrendering to the reality that losses will happen, that drawdowns will come, that no edge wins forever. And strangely, in that surrender, you gain power, because you stop wasting energy resisting what is, and you start focusing on what matters. Paul Tudor Jones once said, "The most important rule of trading is to play great defense, not great offense." That's what surrender gives you. It lets you stop chasing control and start protecting capital. Think about position sizing. It's not sexy, it's not exciting, but it's control, real control over risk. When you size correctly, you can survive randomness. You can weather the unexpected. When you over-leverage, you're saying, "I'm certain this trade will work." You're placing a bet on control. And when that illusion breaks, it breaks hard. That's how accounts blow up. Not from bad trades, but from too much conviction in the wrong places. Conviction belongs in the process, not the outcome. Let's talk about stop losses. A stop is a line you draw to say, "If I'm wrong, I'll step aside." But some traders move the stop. They think it's just a little noise. It'll come back. Or worse, "I can't afford to lose here." That's not strategy. That's ego. That's fear pretending to be control. Douglas wrote about this beautifully. He said that trading well comes down to accepting the risk before you enter. That means asking yourself, can I take this loss and be okay? Can I be wrong and still feel whole? If the answer is no, you're not trading from strength. You're trading from attachment. And that attachment, that emotional grip, is what leads to sabotage. Because the tighter you cling, the harder it is to act when things go against you. You hesitate, you hope, you freeze, and suddenly you're not executing anymore. You're reacting. That's not mastery. That's survival mode. So here's the paradox. The best traders don't try to control the market. They control themselves so they can respond fluidly to whatever the market gives. It's like surfing. You don't control the wave. You don't control the ocean. But you learn to read it, to move with it, to fall and get back up. That's trading. And like any surfer knows, some waves will knock you flat. But if you try to control the ocean, you drown. The goal is not certainty. It's adaptability. It's flexibility grounded in discipline. Let's talk about margin of safety, a concept borrowed from investing made famous by Benjamin Graham. It means leaving room for error, room for variance, room for being wrong. Most traders leave no room. They trade right up to the edge emotionally and financially. And when things go wrong, there's no cushion, just panic. But when you trade with margin, in your sizing, in your expectations, in your mental bandwidth, you create space. Space to think, to breathe, to stay calm. And in that space, real control emerges, not over the market, but over your process, your rituals, your reactions, your recovery. That's what professionals understand. That trading well is not about domination. It's about cooperation with the market, with yourself, with probability. So tonight, if you feel the need to force a trade, to make it back, to prove something, pause. Ask, am I acting from control or from fear of not being in control? Then step back, recenter, let go of what you cannot hold. Because the truth is, mastery in trading doesn't come from gripping tighter. It comes from releasing smarter. Drawdown. It's a word traders whisper like a storm approaching, a shadow that follows every high. And if you've traded long enough, you know it's not a matter of if, it's a matter of when. And when it comes, it doesn't always arrive with chaos. Sometimes it creeps in quietly. A few losses, a missed entry, a little overtrading. Then you look up, and the equity curve is bending downward. You feel it in your chest. The pressure, the silence, the shrinking confidence. Drawdown isn't just a financial phenomenon. It's emotional, spiritual even. Because in that moment, when you're down, Everything you thought you knew feels shaky. Every win from before feels distant. And the mind starts whispering, maybe I've lost it. Let's pause here. If you've ever felt this, you're not alone. Every trader, even the greats, has faced drawdowns. Paul Tudor Jones, Peter Lynch, Ray Dalio. They've all been there, not just financially, but emotionally. And what separates them isn't that they avoid the fall. It's that they know how to fall well. See, drawdown has a hidden purpose. It's not just pain. It's a mirror. It shows you what you really believe. It reveals how attached you are to your identity as a winning trader. It tests your relationship with risk, with discipline, with self-worth. And if you're not careful, it will drive you into sabotage. You start doubling your position size, trying to make it back with one big win. Revenge trading, system hopping, abandoning your edge just to feel something again. This is where traders self-destruct, not because of the market, but because of their response to the market. Mark Douglas talked about this often. He said that consistency is not the result of genius, but of mindset. That the truly consistent traders don't tie their self-worth to performance. They've made peace with loss. They've decoupled outcomes from identity. They've accepted that drawdowns are part of the process, not a failure of it. And that's the shift. That's the real work. Let me say something plainly. You can have an incredible edge, but if your psychology breaks in a drawdown, you won't last long enough to see it pay off. That's why emotional capital is just as important as financial capital. It's the reservoir of belief, patience, and resilience you draw from when the numbers are against you. And just like any account balance, if you overdraw, it takes time to rebuild. So how do we protect that reservoir? How do we carry ourselves through drawdowns without breaking? We start by normalizing them. Understand every system has a maximum drawdown, a statistical expectation of pain. And if your system doesn't have that calculated, you're flying blind. Run the backtests. Know the worst-case scenario. Then prepare for it. Emotionally, financially, structurally. Because if you only love your system when it wins, you don't have a system. You have an addiction to validation. Real systems are designed to survive the dark stretches. And real traders know how to endure them. Let's talk about one more piece: identity. Drawdowns hurt most when your sense of self is tied to results. If being a successful trader is central to your self-esteem, then every red day becomes a personal attack. But what if you weren't here to prove anything? What if trading was just a craft, a discipline, not a performance? Then drawdowns become data, nothing more. Signals, not stories. And with that shift, you stop spiraling. You stop interpreting pain as failure. You start asking better questions. Is my system broken? Or is this just variance? Am I following my rules? Or trading from fear? And most of all, what can I learn here? Because drawdowns teach. They teach humility. They teach risk. They teach patience. You won't always like the lessons, but if you listen, you'll emerge better, cleaner, sharper, more detached. Not cold, but clear. And clarity is rare in this game. So tonight, if you're in drawdown, if you're questioning your edge, if your chest feels tight, and your journal pages are heavy, know this: you are not broken. You are becoming. This is part of it. And when it lifts, and it will, you'll carry something quieter than confidence. You'll carry self-trust. And that more than any win is what keeps you in the game. It's late. The market's closed. And maybe somewhere deep in your chest, there's that pull again. The need to know. What's going to happen tomorrow? Will the Fed raise rates? Will the breakout hold? Will that swing trade finally reverse? The questions spin, and behind them always is the desire for certainty. We all want it, but trading isn't about certainty. It's about probability. And accepting that, truly internalizing it, is one of the hardest shifts a trader ever makes, because everything around us, from childhood to career paths, teaches us to seek answers, to be right, to prepare, predict, and perfect. But in trading, being right doesn't mean you'll make money, and being wrong doesn't mean you'll lose. It's not about one outcome, it's about many, repeated, over time. Let me explain. Imagine flipping a coin, 50-50. You know the odds, but what if the first flip is tails, then tails again, then again? 4, 5 losses in a row. Does that mean the coin is broken? No, it's variance. Now imagine that coin is your edge. Say a setup with 60% win rate. That still means 4 out of 10 trades will lose, sometimes more, sometimes clustered together. And if you panic at each loss, if you abandon the system because of short-term pain, you never give the probabilities room to play out. This is the cornerstone of Mark Douglas's teaching. He said a consistently profitable trader thinks in probabilities, not outcomes. That's the shift from amateur to pro, from emotional to statistical. But it's not easy, because our brains aren't wired for probability. We're wired for story, for cause and effect, for reasons, not randomness. So when a trade fails, we go looking. We blame the news, we second-guess the setup, we search for what we missed. But sometimes, you didn't miss anything. It was just a loss within expectation. Nothing more. And that realization, it's freeing, because it moves you out of punishment and into process. Let's take an example. Suppose your strategy has a 70% win rate. You risk 1 unit to make 2. Over 10 trades, statistically, you'll win 7, lose 3. That's a net of plus 111 units. Now, what if you lose the first 3 trades? Most traders quit, change systems, get emotional, take bad trades to compensate. But if you stay consistent, the edge plays out. This is what it means to trade probabilities. You stop judging the individual trade. You judge your execution over a large enough sample size. Warren Buffett once said, "You don't have to be right a lot. You just have to be right on the big ones and not get killed on the rest." That's risk-reward. That's probability thinking. Let's talk about that too. Risk-reward ratio is the cornerstone of probability. It's not just about how often you win, it's about how much you win when you do. If you risk 1 to make 3, you can be wrong 6 times out of 10 and still make money. But here's the catch. You have to take all the trades, even the ones that feel scary, even the ones after a loss. That's the hard part. The emotional weight of probability is often heavier than the math, because you know, this trade could be one of the losers, and that knowledge creates hesitation. But if you hesitate, you miss your edge, you break the sequence. And the probabilities depend on the sequence, not perfect execution, but consistent execution. So the goal becomes this, not to predict the next outcome, but to trade your edge again and again, without fear, without hope, without needing this one to work. That's where freedom is, in detachment. Let's talk about another concept, expected value. It's a simple but powerful idea. If you repeat this trade 100 times, what would the average result be? That's what matters. Not this trade, not the next one, but the curve over time. You see, when you think in probabilities, you stop trading emotionally. You stop taking wins personally. You stop taking losses personally. You become the house, not the gambler. You place your edge on the table and let the law of large numbers do its job. And when you do that, truly do it, you step into a different mindset. A quieter one, more patient, more precise. You're no longer trying to win, you're trying to execute. Because over enough time, edge plus discipline equals profit. So tonight, if you find yourself staring at the charts, trying to figure it out, trying to know, let go. Shift your focus from the next candle to the next 100 trades. Zoom out, breathe, and remember, you're not a fortune teller. You're a risk manager, a probability player. And if you play well, If you play honestly, the results will come. Not perfectly, but profitably. It's still dark. No notifications. Just you and the screen. And maybe somewhere in the back of your mind, a voice whispering, "Is this even working?" That voice usually shows up when things feel slow, when growth feels invisible, when you're not blowing up your account, but you're not doubling it either. And in that space, it's easy to drift, to chase, to push for something dramatic. But that's not where mastery lives. Mastery lives in the quiet, in the daily returns that don't feel like much, in the hours of backtesting no one sees, in the restraint you show when others rush. And behind it all, there's one principle working quietly, powerfully, always. Compounding. Most traders hear that word and think of money. But compounding isn't just a financial concept. It's a universal law. It governs how skill grows, how discipline deepens, how beliefs are reshaped, and how wealth, true lasting wealth, is created. Let's start with the financial side. Compounding returns, the steady reinvestment of profit, is the closest thing we have to magic in this space. Einstein reportedly called it the eighth wonder of the world, because over time even small gains, when reinvested and left untouched, create exponential growth. Let me give you a simple picture. Imagine you grow your capital by just 1% a day. That doesn't sound like much, but 1% daily consistently compounds into over 37 times your original capital in a year. Now that's an idealized example. Real-world returns are messier. There are drawdowns, flat periods, losing streaks. But the principle holds: small edges applied consistently, beat big wins chased sporadically. But there's a deeper layer here, because money isn't the only thing that compounds. Habits compound. Every time you journal your trade, even when you don't want to, you're reinforcing discipline. Every time you follow your stop loss, even after a string of losses, you're compounding trust in your system. Every time you skip a trade that doesn't meet your rules, you're building the invisible muscle of restraint. And those actions, those little invisible wins, they compound into who you become. Peter Lynch once said, "The real key to making money in stocks is not to get scared out of them." He wasn't just talking about holding through volatility. He was talking about staying in the game, letting the slow work work. Because in this field, the real edge isn't just your system, it's your consistency. That's what compounds. Let me offer a metaphor. Imagine a bamboo seed. You plant it, water it, tend to it. For a year, nothing. 2 years, still nothing. 3 years, no sign of growth. But then, in the 5th year, it shoots up 80 feet in weeks. Did it grow in those weeks? Or was it growing unseen the whole time? That's how trading mastery feels. Quiet, unseen, then visible. And when it shows, it looks like sudden success. But it's not. It's the result of compounding habits, compounding beliefs, compounding insight. So why do so many traders never reach this point? Because compounding demands something our culture resists: patience. In a world of instant signals and algorithmic speed, waiting feels like failure. Slow feels like wrong. But in markets, slowness is strength. Restraint is edge. Simplicity is genius. Benjamin Graham taught that in the short run, the market is a voting machine. In the long run, it is a weighing machine. The same applies to your trading performance. Short term, it's noise, votes, randomness. But over time, the weight of your habits shows. The mass of your decisions adds up. The curve begins to bend, and it bends quietly. Not in fireworks, but in quiet equity curves that rise like a tide. So tonight, if you feel stuck, like your efforts aren't showing, zoom out. Look not at today's P&L, but at the arc of your process. Are you journaling more, following rules more, reacting less? That's growth. That's compounding. That's the bamboo root system taking hold. And yes, it's invisible for a while. But when it blooms, you'll be ready, rooted, not surprised by the success, but prepared for it. So when in doubt, repeat the process. Repeat the rules. Repeat the restraint. Because what feels like nothing now may be everything later. It's almost morning now. The charts are still quiet. And maybe you're feeling that low reflective pulse that comes after the storm, after a hard week of trades, or a hard month of silence. This is the space where real insight appears. Not in the noise, not in the rush, but in the stillness. Because trading beneath all the analysis and execution is a mirror. And the deeper you go into markets, the more you end up staring at yourself. And what you find there, that's what decides everything. The final truth is this: markets are not controllable, but you are. And until you make peace with that, you will suffer. Let me explain. Mark Douglas, in Trading in the Zone, talked about the idea of psychological risk. The internal pressure we feel when outcomes are uncertain, but our identities are attached. And identity for traders is dangerous territory. Because if every trade is a reflection of your intelligence, then a losing trade becomes a threat to your ego. And if your worth is measured in equity curves, then you'll panic at every drawdown. So how do you move past that? You detach. But not in the cold, indifferent way. Not in the nothing matters sense. That's avoidance. That's burnout. No, the detachment I'm speaking of is active, engaged, but emotionally centered. It says, I care about the craft. I respect the capital. But I do not need this trade to succeed in order to feel secure. It's a kind of spiritual resilience, really. The same kind you see in martial artists, or chess grandmasters, or monks who spend their lives shaping a single sand mandala just to sweep it away. Because they know. Mastery is not in the outcome. It's in the posture, the process, the way. Let's talk practically. You will have losing months. You will be wrong. You will feel stupid, frustrated, tempted. But if you measure success by how well you followed your edge, rather than whether it worked this time, you become unshakable. That's what emotional detachment looks like. And it's paradoxical, because when you stop needing to win, you start to trade better, cleaner, looser, freer. And that freedom, it doesn't mean recklessness. It means clarity. Paul Tudor Jones once said, "The secret to being successful from a trading perspective is to have an indefatigable and undying love for the process. Not the profits, not the glory, the process." That means knowing yourself, knowing your risk, knowing when to walk away, when to step back, when to say enough for today. It means understanding the deep truth of the market. You don't control outcomes, you only control yourself. That's it. And oddly enough, that's all you need. Because once you stop chasing certainty and start nurturing consistency, you move from fragile to anti-fragile. You stop being a gambler with a dream and start becoming a professional with a system, a trader with posture, with peace. Not because it's easy, but because you've learned how to breathe through the chaos. And that's rare, and beautiful, and necessary. So, as this long night begins to close, let me leave you with this. You don't need to be perfect. You don't need to be brilliant. You just need to stay in the game, stay aware, stay aligned. Detach from the illusion of control. Hold fast to your edge. And let the market do what it does. Because mastery isn't about dominating the market. It's about dancing with it. Lightly, disciplined, detached. Let it move. You move with it. And over time, if you remain true, the results will reflect your process. Maybe not right away. Maybe not the way you expect. But they will come. Because success in trading begins in silence, in patience, in self-trust. Now let's breathe together for a moment. No charts, no news, just stillness. You made it this far, and that means something. So before you go, I'll ask softly, what part of this spoke to you most? Have you ever faced a loss like this? What did you learn from it? Drop a comment. I'd love to hear your story. And if this kind of quiet, thoughtful trading content speaks to you, consider subscribing. It keeps this space alive. Until next time.